Ever wonder what a candlestick chart actually reveals about price movements in the market? Think of it like a visual summary of a story, but instead of characters and plots, we have price action. Each candlestick is a single data point that tells us how the price of an asset moved during a specific time frame, whether that's minutes, hours, or days. Each candlestick has four key components: the opening price, the closing price, the highest price, and the lowest price. Picture it like a candle. The body of the candlestick shows the opening and closing prices. If the closing price is higher than the opening price, that candlestick is typically filled with a lighter color, like green or white, indicating bullish sentiment. But if the closing price is lower, it's darker, like red or black, pointing to bearish sentiment. And here's the surprising part. The thin lines sticking out from the top and bottom of the body are called wicks. They reveal the highest and lowest prices during that time period, kind of like the highs and lows of a roller coaster ride. If you see a long wick at the top, it means prices shot up but then fell back down, while a long wick at the bottom shows a drop that bounced back up. So when you look at a candlestick chart, you're not just seeing pulses. You're witnessing the battle between buyers and sellers over time. Who's winning and who's losing? This visual can help you understand market sentiment quickly and clearly. Now you know what a candlestick chart is and how it works. If you want to dive deeper into how to interpret these charts, stick around for the next scenes. What exactly does each candlestick represent? Picture a candlestick as a mini report card for a specific time period, like a quick summary of how a stock or asset performed. Each one reveals four key price points: the open, high, low, and close. Let's break it down. The open is where the price starts at the beginning of that time frame. Think of it like the starting line in a race. Then we have the high, which is the peak price reached during that time. It's akin to the runner who sprints ahead to grab the lead. Next is the low, representing the lowest price point achieved, just like a runner who faces a stumble or a fall but manages to recover. Finally, we get to the close, which is where the price ends at the end of the period, like the finish line. Now here's the surprising part. The relationship between these points tells a powerful story. If the close is higher than the open, the candlestick is typically filled with a lighter color, indicating positive momentum, much like a runner crossing the finish line ahead of the pack. Conversely, if the close price is lower than the open, it often appears darker, suggesting a downturn. This visual representation not only captures price actions, but also provides insight into market sentiment. Traders look at how these candlesticks form patterns over time to gauge market behavior. So each candlestick isn't just data. It's a narrative about what happened in the market during that time frame. Understanding this anatomy is crucial for navigating the world of trading. What does the body and wick of a candlestick actually tell us? Think of the candlestick like a roller coaster ride. The body represents the ride's thrilling ups and downs, while the wicks show us the ultimate peaks and valleys experienced along the way. The body of the candlestick is formed by the opening and closing prices within a specific time frame, say 1 hour or 1 day. If the closing price is higher than the opening price, the body is typically colored green or white, suggesting that prices climbed during that period. Conversely, if the closing price is lower than the opening price, the body is red or black, indicating a drop. Now here's where it gets interesting. The wicks, those thin lines extending above and below the body, represent the highest and lowest prices reached during that same time frame. Imagine you're at the top of a roller coaster. This is the high point, or the upper wick. When you plummet down, hitting the low point before rising again, that's reflected as the lower wick. So if you see a candlestick with a long upper wick and a small body, it tells you that while prices tried to climb high, they ultimately fell back down before the period closed. It's like reaching for the sky, but coming back down quickly, an indication of selling pressure. On the other hand, a long lower wick with a small body suggests buyers stepped in to push prices back up after a dip, showing resilience. In essence, the body indicates the net result of trading activity, while the wicks provide insight into the volatility and price extremes of that period. Understanding these elements can reveal a lot about market sentiment and behavior. So next time you look at a candlestick chart, remember that each body and wick tells a story of the market's journey. Keep watching, and you'll uncover even more layers in the world of candlestick charts. Have you ever wondered why the color of a candlestick is significant? It's more than just aesthetics. It's a crucial indicator of market sentiment. A green or white candlestick signals that the closing price was higher than the opening price. This means buyers were in control during that time frame, pushing prices up. Think of it as a green light. Everything is moving forward, which generally reflects positive sentiment about that asset. On the other hand, a red or black candlestick tells a different story. It indicates that the closing price was lower than the opening price, meaning sellers dominated. Picture a red light. It's a signal to pause and reconsider, because the market is showing signs of weakness. This shift in colors can help you gauge the overall mood of traders. But here's the surprising part. The strength of that sentiment can also be inferred from the size of the body. A tall green candlestick suggests strong buying pressure, while a tall red one shows intense selling. Conversely, short bodies, whether green or red, indicate indecision, where neither buyers nor sellers have full control. So the colors of candlesticks aren't just decorative. They help traders visualize the tug-of-war between buyers and sellers in real time. Understanding this can sharpen your insight into potential price movements. In summary, the color of a candlestick reveals crucial information about market sentiment, with green signaling buying strength and red indicating selling pressure. By paying attention to these colors, you can start to see the underlying dynamics of the market more clearly. What do you see when you look at multiple candlesticks together? Patterns start to emerge, and that's where the real story of the market unfolds. Think of it like watching the ocean waves. When the tide comes in consistently, you know it's a sign of something big, like a rising trend. For instance, if you spot a series of green candles stacked one after the other, that's your signal that buyers are in control, pushing prices up. Each green candlestick represents a period where the closing price is higher than the opening price, which suggests strong demand. It's like a parade of surfers riding the waves. The momentum is building, and the excitement is palpable. Now here's the surprising part. Just as the tide can shift, so can market sentiment. If you notice a string of red candles following those green ones, you might be witnessing a bearish trend. Each red candle signals that sellers have taken charge, with prices closing lower than they opened. It's like the tide pulling back, revealing the sandy bottom as the waves retreat. These patterns, clusters of green or red candles, can help traders identify potential trends. For instance, a series of 3 or more green candles often indicates a strong bullish trend, while 3 or more red candles could point to a bearish downturn. By recognizing these patterns, you're not just watching the market. We're understanding its rhythm and flow. So the next time you look at a candlestick chart, remember, it's all about reading those waves and flows. It's a powerful way to gauge market sentiment. If you're looking to deepen your understanding of market movements, stay curious and keep exploring these patterns. What does a candlestick chart truly reveal about market behavior? It's not just a jumble of colorful bars. It's a visual narrative that tells you the story of supply and demand over time. When you look at these charts, you're peering into a dynamic conversation between buyers and sellers. Each candlestick represents a specific time frame, showing the open, close, high, and low prices. The body reveals whether the price closed higher or lower than it opened, and the wicks illustrate the price extremes during that period. Now here's the surprising part. The patterns formed by these candlesticks can indicate shifts in market sentiment. For instance, a series of long green candles might suggest strong buying pressure, while a sudden streak of red candles could signal a bearish trend. By understanding these visual cues, you can better gauge whether the market is feeling optimistic or pessimistic. And remember, candlestick patterns are not just isolated signals. They exist within the broader context of market conditions, news events, and economic indicators. That's the bigger picture. When you combine candlestick analysis with other tools like volume and trend lines, you start to create a more nuanced understanding of market dynamics. In essence, mastering candlestick charts is about decoding the emotions of the market. It empowers you to make more informed decisions based on historical price movements and current trends. So if you found this perspective enlightening and you want to dive deeper into the world of market mechanics, you know what to do. Hit that subscribe button for more insights and keep exploring the fascinating realm of trading and finance.